Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome to another episode of the Valmika Property Investing Podcast. This week, we're going to speak about the cycles that you go through in investments. So I'm going to go through the four main cycles of investment cycles that we go through in the property market. And I'm going to explain where we sit at the moment in those cycles and where to from here. What is the opportunity? So firstly, what are the economic cycles? So there are four main cycles that I like to classify. First one is the most popular one, and that's the bull market cycle. This is characterized by a low interest rate environment, or low relative to historical or recent historical interest rates. It is characterized by the fear of missing out. It is characterized by cheap funding on the back of low interest rates. Here you find that there's a lot of competition for property. Auctions are full. The agents are swamped with bidders coming into the market, and it's definitely driven by a seller's market. So they can demand higher prices, and property tends to spike up in value. The next stage is what I call the bear transition phase. This is when inflation starts to get out of hand, wage sector growth is too strong. Reserve banks around the world are starting to speak about inflation becoming a problem, and hence, on the back of it, interest rate hikes. In the bear transition phase, the market's still pretty strong. However, people are starting to get worried about interest rates going up and property becoming more costly to carry, so to speak. The reserve banks then start hiking interest rates, and then everyone holds back thinking, we want to see how high these interest rates can go. And basically, the market grinds to a much slower interest, so to speak. Less bidders in the market. The market dynamics shift from a seller's market to a buyer's market. A classic example of this is 2022. So in 2022, we went into an aggressive hiking cycle, not only in Australia, but around the world. And it was led by countries like New Zealand, in fact, our neighbors, and then the US, Canada, so those developed nations. And the whole world went into an inflation spike and a strong wage sector spike and an aggressive hiking cycle. And as a result, bear market pursued, and property prices started to decline from a lack of interest in people buying. Now, the next stage is the bull transition phase, and that's the phase that we are currently in now. So this typically happens when the market starts to come close to or is at the peak in interest rate hiking cycle, and it is starting to speculate when the next cuts will start to happen. In the bull transition phase, which we're in now, people that have been sitting on the sidelines are starting to gain interest in the market and are starting to go into the market to try and take advantage of market prices being lower than they were in the previous bull market. So they're looking to take advantage of opportunities before the next bull market starts, because when the next bull market starts, it tends to accelerate and run away in terms of pricing. So that's the current level or stage that we're in now. Then, of course, it moves again into where inflation's under control and the unemployment sector starts to increase. And as a result, the reserve banks call an end to the hiking cycle and they start the next cutting cycle phase. And that's when we start the bull market phase again. So it's broken down into those four stages. So let's describe the current economic cycle where we're in and the opportunities that you should be taking in the various cycles. So currently we are close, if not at rather, the top of the hiking cycle. So there's still a chance in Australia as of the 10th of December 2023, pending the CPI print at the end of January, which includes the service CPI factors in the CPI print. The most recent one didn't include the services, therefore it is misleading. So even though inflation had come down, you find that because it doesn't include the service inflation metrics, it's not as trustworthy as the quarterly print, which will happen in January. If in January that quarterly print shows at least that inflation is not sticky anymore and it's coming down, then there's a good chance that we'd be at the top of the hiking cycle and the next move will be down. And this is especially true in the back of lower GDP numbers that we received last week. So as a result, we are close to that end of the bear market and we're in that bull market transition phase. So what are the opportunities? The best time to purchase property is during bear markets. And the reason being is that property goes on sale. So you get discounted properties and good assets at a discounted price. Then the bear market phase, you get other opportunists coming into the market to take advantage of property prices, even though they have started to come up in value and in prices. They'll start to come in and acquire some of those assets. Then when we go into the bull market and interest rate cuts happen, then the market floods in and starts to buy property. So the ideal situation is in bear market, you're acquiring your assets. Bull market, you're actually taking some of those assets off your books. But this is a very difficult thing to time, even though the market cycles are very clear, because it's difficult to time them exactly, and you don't know how deep the bull market runs. So, for example, the bull market can run for several years, or it could run for a year and a bit. And it's difficult to time that, and you want to take advantage of much of the growth as possible. So what we advise when building a portfolio is to have some great growth assets when you're moving into the bull market. And if you don't have those growth assets, the best time to acquire them is in the bear market. Then in the bull market, while your growth assets are kicking in, you need to plan for the next bear market. And that can happen in one of two ways. One, you start selling off some of your growth properties, so that when you move into the next bear cycle, you can afford to hold on to the portfolio or the remaining portfolio that you have, because you're going to have higher costs of funding and higher capital commitments every month. If you do not offload those properties and you take a longer term view in them, which many of our clients do, then what we recommend is taking some of the equity that is in those assets and purchasing positive cash flow assets in the form of commercial property or in areas around the country that have got higher yielding residential property. So it's good to plan for the next bear market, because those higher cash flow properties allow you to stay in the game, so to speak. They will provide you that staying power to hold on to your portfolio. And holding on to your portfolio for the longer term is what grows wealth and allows you to stay in the game and builds you a prosperous future. I hope that was valuable. And if there's any other topic you would like me to go over in more detail from what I've described here today, please drop a comment and I will definitely follow it up. So moving on to the auction clearance results for the weekend ending the 10th of December 2023. A good showing for majority of the states, with Victoria clearing at 65% and Melbourne clearing at 66%. So it's maintaining that strong clearance rate. South Australia still in the lead at a 79.5% state clearance rate, with Adelaide clearing at almost 81%. Then looking at New South Wales, 65% clearance rate for the state, with Sydney clearing at 66.3%. ACT clearing at 60.8%, Canberra matching that. Then looking at Western Australia clearing at 58%, with Perth clearing at 63.6%. So the statewide clearance rates are still showing that shortage in supply of property in Australia. And when the next bull market starts, which I predict to be around the second quarter of 2024, and this especially will occur if the US goes into their cutting cycle, which may happen in the first quarter of 2024. Then, because of that supply shortage, I think the next bull market will be pretty strong. So it's worthwhile to acquire assets while you can before that bull market starts. Hope you found this episode valuable, and we look forward to speaking with you in the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.